Welcome everyone to the Junior League of Bergen County's last training of this league year, Women in Investing. It is my pleasure to introduce tonight's speaker, Rebecca Golemski, who has 21 years of investment experience and is a longtime member of the Junior League of Bergen County and is currently a sustainer with the organization. And Rebecca, I'm going to turn things over to you and let you tell everybody a little more about yourself.
Sure. I'm not sure if I know everyone on the presentation tonight, but I'm happy to be presenting on women in investing. And most of you know me. I'm Rebecca Golemski. As Britt said, I'm a longtime member of the Bergen County Junior League of Bergen County, and I've been a financial advisor now for 21 years. And a lot of that time, I've seen different types of people, different needs. Just a lot of different ways of investing. And when it comes to investing, it's a lot more than just what you buy and sell with your stocks or bonds or mutual funds. It's all about making sure that you're doing everything right for you and your family when it comes to cash, how you invest cash for the greatest rate of return, determining your needs when it comes to emergency savings, when it comes to protection, whether that's life, disability, long-term care. And we'll just go into a little bit more about each of the categories of investments, should we say. Everyone should really look at, what I've done is really just do something and I've done this training before for Junior League face-to-face, and I can't wait till we can really do that again, which is, down the road, we'll all be vaccinated, we'll all be comfortable with what we can do face-to-face. And but what I've really kind of narrowed this down to is 10 things that women should know when it comes to investing. And I'll be happy to share this with you afterwards. And if anybody has questions as we're going along, if you want to just unmute yourself and ask a question, it's a small group, so we can certainly manage, together, or just put something in the chat and I'll be sure to cover the topic. So importantly is financial planning, that everyone should know what your net worth is, what your cash flow looks like with your budgeting. People are at different ages, different stages of life. It might be whether you have children or you don't, or you have aging parents. It's all going to affect our financial plan, what we need to do to help our families, ourselves, for the future. We all want to live in a retirement situation where we're comfortable, where we're not worried, where, you have enough and you've saved it in the right ways. There's different ways to save your money, whether it's tax-free, it's taxable, or tax-deferred. And we'll get into that a little bit more. But the point is that everyone is at a different stage, and, your age will affect how you invest, how you feel comfortable with investing, with your risk tolerances, and what stage of life you're in. Again, if you're starting a family, if you're closer to retirement, whatever that might be that is important to you, that's what you want to convey to your advisor or to your trusted, someone that you trust to help you with your finances, and just look at, what is comfortable for you. Because a lot of times what I see is, oh, I heard from my brother, or I heard from my uncle that they should be doing this or that. And it's not always appropriate for you. And they may be in a different situation financially or just in general. So some of the things with financial planning, you have to look at your cash flow. So what are you bringing in and what is going out, your income and your expenses. You want to make sure that you have enough in your reserves to just be protected in the case of any emergency. It could be household, it could be health-wise, but you just want to have, and it's tried and true, 3 to 6 months of emergency savings that's liquid to you that you can actually get at. So you want to determine what that magic number is, what your fixed expenses are, and just add it up, and what is 3 to 6 months, and how do we go about saving that, or making sure that that's on the side as a cash reserve. Your income and expenses would, your expenses, a lot of times we don't think of things are discretionary expenses, shopping for clothing, going out to eat, that's discretionary. It's not something that you have to do or you have to have a fixed amount for every month. So whether it's dining out, your mortgage and your food and, insurances, things like that, those are fixed expenses, and that's non-discretionary. You have to pay for it. You have to have it for the most part. You have to have enough money to have those things every month. A lot of times we don't think of expenses as, part of our community service, right? It's an expense when you give to charity, when you go out into the community and you're helping or you're donating things, that is an expense to you, but we don't think of it as part of our cash flow. But it really is, whether it's, junior league dues or just in general, we don't think of that as a line item of our expenses, but we really should. There are associated costs to things like that. There's associated costs to training, not this training particularly, but, we go to different classes or take different courses, and there's always a cost to something. So you want to just be aware of what that is and determine how that fits into your budget. Determine on a monthly or annual basis how much in your expense you should be accounting for. You also want to account for hobbies, right? We want to go out to eat and we want to go to shows and we want to go, whatever your hobbies might be, whether it's golf or travel or sports or the arts. But we don't often think of that as an expense, and we often don't account for that in our income and expense outflow. So it's something to be notable of. You want to determine your net worth. What is your net worth? Well, that's not just what's in your bank account. It's obviously the equity in your home or, what you actually own, in addition to any kind of retirement plans that you might have, cash value life insurance. That's all going to add up to be an amount that contributes to your net worth. So you want to know what that magic number is based on your situation. So that's number one, is financial planning. Number two would be retirement. So this is usually the biggest asset that most of us would have next to a home or, other any type of monies that you have saved. But retirement, your retirement account, which is usually a 401k, a 403b, if you're in the hospital situation or medical field, is usually a 403b. 457 plan, that's a municipal. If you work for if you work for the city or the town or you live in, or even governmental, that's a 457 plan. All of these are tax deferred, but what happens is that when you go to take it out, when you retire, you're going to pay taxes on these types of accounts. So you want to make sure that it used to be where when people retired, they typically had less money or less income, so they weren't in a higher tax bracket. But now that's not necessarily true, because we're saving more and our income is going to be higher in retirement, or in some cases equivalent. If you have a pension, you add in Social Security, and these things are going to be taxable to you. So you want to be mindful of your retirement plans. So these are all typically, if you have an employer-sponsored plan, a lot of times I hear from people that they're not contributing to their employer-sponsored plan if there's not a match. A match is really free money from the corporate structure that, or an employer, that they're giving you towards your retirement plan, but it still benefits you to contribute to a 401k plan or an employer-sponsored plan regardless of the match. You're reducing your taxable income, and ongoing, you're just saving for your future. So, the tax deferral is it's an important feature, because you're not paying taxes on that money. For instance, if you made $100,000, you save $10,000, you're only taxed on $90,000 if you put that into a 401k or a tax deferred plan. Another great feature that has come out in employer-sponsored plans is a Roth IRA and a Roth 401k. Those are not taxed when you take them out upon retirement, and you're not required to take them out. So those can be left as a legacy should you want to do that. So we've gone through financial planning and your retirement. Number 3 would be investments. How are you investing? So are you allocated properly? Are you overweight in large cap growth stocks? You know, some of the Fortune 500 companies, S&P 500, the Dow Jones stocks are growth stocks typically. And the problem with that is that people get over allocated in large cap growth, and you're not giving yourself a diversified portfolio. Whereas you should have large cap growth and value, you should have small and mid cap stocks, and you should also have some fixed income in your portfolios. That's giving you diversity so that you can weather the storms when things happen, when the market goes up and down. So you don't want to be over allocated and overlap your investments. So you want to have that diversification. You also want to have some guaranteed income when retirement comes, whether that's in the form of guaranteed income annuities, which provide a certain amount, and usually that income does not decrease over time. Typically, you would look at that later, closer to retirement, so that you can guarantee income. Your guaranteed income is obviously going to be your Social Security, any pensions. Then a guaranteed annuity can also provide that to you as far as guaranteed income, or bonds, bonds or the interest and dividends from your investments. So it just depends on your risk tolerance as to how you wish to invest for the purpose of creating that interest and dividends later on, or currently, if you don't have monies invested in retirement plans, you can certainly take dividends as opposed to reinvesting them, and that could be cash flow. So you want to make sure that you're diversified. You also want to determine what is your objectives. Do you have short-term goals? Do you have something, you're going to do a new home purchase, you're going to buy a new car, or is it something a little bit longer term, like college education? How are you investing for that purpose? I can speak from experience because I just put my first one through the college and she just graduated. And, it almost seems like there's never enough saved for college because there's always additional expenses. There's always additional cost to college, room and board, and then it's their rent if they don't stay on the dorms, and, food costs and books and everything that goes along with additionally paying for tuition. So that's a little bit more of a longer term goal. And then obviously your goal towards retirement. Do you have enough saved when you look to retire? A big part of investing also is the risk tolerance. How do you feel about investing? How do you feel if you had a 20% drop in your investments? Can you sleep at night? We have clients that absolutely wanted to be out of the market at certain points in time. They see these big drops in the market and they just don't want to be invested aggressively or moderately aggressive. So you want to determine what is your risk tolerance. How do you feel about any fluctuations in value? How do you feel about the market volatility and the way that the markets perform, and how that affects your portfolio personally? Some people just look at the bottom line when they open their statements, and they just look, did I make money, did I lose money? And if there is a big substantial drop, it can be very uncomfortable. So you want to make sure that you're invested in such a way that you're comfortable with the fluctuations in value. And that's a conversation to have, with which includes your goals, short-term, long-term, and also just in general, how you feel about fluctuations and how that affects your portfolio personally. There's always volatility in the market. We've experienced quite a few ups and downs. In 2008, we've been very comfortable since then, after that market crash, if you will. But, in 2008, people really lost a lot of money in their employer sponsored plans, their 401ks. and their portfolio overall, but it took a long time to come back. So you have to just really search yourself and see how you feel about that risk and that market volatility. You also want to stay involved. Some people just kind of set it and forget it when it comes to investments. They don't make changes, and that can be a big mistake too, because you can be overweighted because of growth, and you want to kind of take money off the table and invest it elsewhere. Invest it to be, whether it's more conservative or just to, in general, be more aligned with your goals and your objectives. You want to make changes as needed and rebalance your portfolio periodically. So one of the big things is to stay engaged. Stay engaged in what you have. Do your own review or review with an advisor that this is what I need to do, or this is what I'm uncomfortable with, or what I am comfortable with, so that you know personally how you would feel when things change. The fourth thing on my list here is protection needs. So that includes insurance. Now, a lot of people don't like to talk about life insurance because, it's talking about your demise. But life insurance is an important overall strategy when it comes to financial planning, because it protects those that you love from, if there was a loss of income from you, or a loss of human life value, right? Even if someone doesn't contribute financially so much to the income, if something was to happen to that person, there's an expense to replace what they actually do for their families. So your protection needs are very important when it comes to not only life insurance, but disability. You want to protect your income. If something was to happen where you couldn't work, you want to have at least enough disability insurance to give you a monthly income for a period of time. So that's an important thing to protect your ability to earn. Long-term care, a lot of us might have seen, our parents or other people in our lives that have had a need for long-term care. But it's very expensive to, care for people, whether they're in a home or they have to, you have someone come into the home to care for your loved ones. But long-term care, it used to be that there were only standalone policies, that they were just for the purpose of long-term care, but it was kind of like renting versus owning, right? If you needed it or you had to have it, it was there for you, but you have to pay on an ongoing basis. But that's the difference between permanent insurance and temporary insurance. I'm sorry, that was not long-term care. Permanent insurance and term insurance, there are two different things. That's the rent versus owning analogy. Versus you might have term insurance, but for a certain period of time. And when that matures or comes to the end of the term, 10 years, 15 years, 20 years, it'll be substantially more expensive, and there'll be no cash value built up, just like there would be no equity in a home if you rented versus owning. With long-term care, you can get a standalone policy. But the problem with those standalone policies is that they are relatively expensive when it comes to covering you for any period of time. And if you don't need it, it's basically that you have spent money on premiums throughout the years, and then it might give you a certain amount of coverage, but you'd have to prove that there were quite a few things that you couldn't do for yourself in order to access the long-term care policies. There are newer life insurance policies now that come with a rider that has a long-term care rider with it, so that if you needed to access long-term care for the purpose of your care or your loved one's care, you can access the death benefit earlier than your demise to provide long-term care with a reduction in the death benefit. So those are a lot less expensive than a standalone long-term care policy. And what happens with long-term care policies, the standalone policies, is that they do increase, or they have the ability to increase your premiums. If you have a permanent life insurance policy that has a long-term care rider, typically the premiums will stay the same for the life of the policy. There are different types of policies, but of course, you need to just determine what's best for you. Life insurance can also be used as tax-efficient retirement income. If you have cash value life insurance, the distributions from that, if you were to take money out of your cash value life insurance, are tax-free, such as, and so is a death benefit. A death benefit is tax-free to the beneficiaries. And speaking of beneficiaries, you want to do a beneficiary review, not only on your life insurance policy, but your portfolio values, to make sure that it is as intended. A lot of people think that if they have their will set up and that they have a will in place, that any accounts will be paid out to their beneficiaries in that regard. However, it's on whatever is listed on your accounts or on your policies, who the beneficiary is, that's who's going to receive the asset. So if you have, whether it might be an ex-husband or a sister that you don't talk to anymore, or, something like that, it doesn't matter what the will states, whatever is on that particular account in your life insurance policies or your investment accounts, your IRAs, whoever you name the beneficiary directly with those accounts is who's going to be your beneficiary. So you want to do a periodic beneficiary review to make sure that it's set up the way that you intended. And it might be something like you have additional children. So you want to name your child or trust for your child, make sure that it's the way that you intended. Where I see that most is, in a divorce situation. Some people just don't change their beneficiaries. They don't think of certain accounts that they had an ex-spouse named at. So it's just really important to go, to do that review periodically. Property and casualty insurance, you want to make sure that you have sufficient amounts to cover your interest, and also review that regularly. You have additions on your homes, or, your cars change, and you want to make sure that you have enough umbrella insurance to cover in the event of. Nobody likes to discuss insurance or know exactly what their needs are when it comes to covering your loved ones or covering yourself and making sure that you're protected. But it is a very important part of financial planning, because it can be devastating if you or a loved one gets sick or something happens to someone. Then you want to just make sure that that's taken care of. Number 5 would be career and career changers. So, we've seen a lot of people, unfortunately lose their jobs in the past few years. And, you just want to make sure that you do all the right things when it comes to either rolling over your 401k or 457 or whatever type of plan that you might have. You want to just make sure that you do what you can to adjust your investment type, whether it's to roll over into an IRA. You can name a different beneficiary that way if you had to or needed to, but also you want to be aware that you can have more investment choices in an IRA than you might have in a 401k. So if you leave a job, a lot of times what I hear is, well, my 401k is doing really well, I'm going to leave it where it is. That's all well and good, because you do probably have a diversified portfolio. However, you can have other investment choices if you roll it into an IRA. You can purchase stocks, bonds, mutual funds, alternative investments, annuities. There's more investment choices to make if you have it in an IRA versus keeping it in a 401k. If you're under 59 and a half and you take out monies from your retirement plan, there is a 10% penalty. There are certain reasons where you wouldn't be penalized the 10%, such as hardship withdrawals or disability, but you just want to be aware that if you're under 59 and a half and you take a distribution, you're going to be penalized 10% in addition to any distribution being taxed at ordinary income. And just, again, it's important to review and update your beneficiaries. So when it comes to taxes, we've all just gone through tax season, which we had a little bit of a extension, which was kind of nice, but our accountant friends are not really happy with that because it's prolonging their tax season, right? But there were a lot of tax changes in the past few years that we as the end user, the taxpayer, need to be aware of. And it's always good to work with a professional just so that you know that you're getting the best the best deductions that you can, and everything is in good order when it comes to doing your taxes. You want to start, from January 1st to keep good records, to put your charitable contributions to the side, to put your business expenses and anything that you feel that would be beneficial to deduct. Unfortunately, there's not a lot of tax deductions anymore. We used to be able to deduct interest on our home equity lines, or, well, years ago, there was many more deductions that we could take. Now there's not that many deductions that you can take. So consult a tax advisor and work with a professional in that regard. Again, it comes to your retirement accounts. You can look at tax deferral to be contributing to those tax deferred IRAs, 401ks, 457 plans, and just know what tax bracket you're in so that you know how much you are paying in taxes when it comes to income. Because sometimes people will take a distribution from their retirement accounts, and that could put them reasonably into a different tax bracket. Another thing that in the last couple of years has come to light is that we are inheriting IRAs from our older family members, or it doesn't even have to necessarily be older family members, but if it's a beneficial IRA, you used to be able to stretch the income out over your own lifetime if you inherited a beneficial IRA. Now you have to take that distribution within 10 years. Where we're seeing that that's going to create problems is that most of us are now in our prime earnings years. So we are in somewhat of a higher tax bracket. And if we have to take a distribution from a beneficial IRA, that could put us in even a higher tax bracket. So you have to be mindful of that and take distributions accordingly. You want to look at your expenses at what stage of life that you're in. It might be your own activities or children's activities. How are you paying for those things? It's part of your expense and your income statement to make sure that these expenses are accounted for. But again, I could speak from experience. My son is a hockey player. My daughter did competitive cheerleading and travel tournaments and things like that. It can be expensive, and you just want to know whatever it is that you do, that the expenses are in your budget and that you definitely account for those expenses. You can utilize education, pay for education sometimes with cash value life insurance. So again, those cash value life insurances can give you a tax-free income from your cash value life insurances to pay for things like education. We also look at determining whether or not you want to get a life insurance policy for your child while they're younger, so that you can build cash value for them and that they are insured, so that later on in life, they don't have to necessarily worry about going out to get life insurance when they get their own mortgage, when they have their own spouse and children. Because it's been put in place, and it's been put in place at a younger age, so that those things can create cash value in your own net worth. Some of us have to determine special needs and be considerate of if you have special needs children, or your parents might become where they have a need for Medicaid. A lot of times I think that people feel that they're going to spend down all the assets so that their parents can go onto Medicaid. It's really difficult to spend down all of the assets that your parents might have accumulated, because to qualify for Medicaid, you have to have less than $2,000 a month in your accounts. And sometimes that's very difficult to do, because especially in the case of elderly parents, they've accumulated a portfolio, they own a home, and they have retirement assets that would be taxed, and they also have cash value life insurance. So all those things have to be a consideration when doing some planning. When it comes to legacy, you want to look at the estate plans that you have created. Everyone needs a will, a power of attorney, a medical power of attorney. Have someone that's trusted to you to make those decisions for you financially and medically, should something ever happen to you that you can't make those decisions on your own. Life insurance especially can be flexible. So in your estate planning, whether you have a need for life insurance to become a legacy or to provide a need, that's all part of your estate plan. But you should have those things in place and determine whether or not, if it's affordable. Permanent coverage when it comes to life insurance is always important. You have a social responsibility. Some people have charitable intentions. Some people have intentions, to leave behind to, some of their favorite charities, or, it might be your family, but certainly Uncle Sam can participate in one of those, be a benefactor to what you're leaving behind as far as estate taxes. So again, you want to plan for your estate and special needs. You want to plan for, any protection needs, whether that's disability, life. You want to plan if you are intending to help a loved one to eventually get to a case where they can benefit from Medicaid. You want to plan for that because there's a 5-year look back. Anything that you might want to move monies around, there's a 5-year look back. It used to be 3 years. There's always also gifting strategies when it comes to estate planning. We as individuals can gift to anyone $15,000 per year. And what that does is reduces the size of your estate. So that's always important as well. We all have different life events that we're going to go through. That's job changing, marriage, perhaps divorce, unfortunately, widowhood, retirement. These are all life-changing events. So at those points in time, you want to definitely review your financial plan and your needs. You want to make sure that you have things in place, when it comes to your parental care and any inheritance that you may receive, or that you want to make sure that those things are in place for those that you love and you want to leave behind. I want to talk, does anybody have any questions about personal financial planning or investments? Or if you want to just put it in the chat and we can make sure that we cover it, we can do that. Or if I should just keep going, I'll do that.
I do have a question.
Sure.
So you know how before you actually touched upon 401k versus a Roth IRA.
Mm-hmm.
And just so I have clarification, because I'm actually going to be starting a new job in 2 weeks. So
Okay.
I have a 401k plan now with Fidelity. When I leave the company, you're saying I should look into the Roth IRA because it'll have more investment choices?
Well, you should look into rolling over a 401k to an IRA. You can't roll a 401k. If it's a traditional 401k, you have to roll that into a traditional IRA, which is tax deferred. There's no tax implications to rolling it over. But in your new company, you want to look and see if they have the option for a Roth 401k. So that going forward, that's a different plan, but that's going to give you the opportunity to have no taxes taken out later. There's no taxes when you take out of a Roth, whereas there's taxes out of a 401k. So a 401k, if you roll that over into an IRA, that's the account. It fits into a traditional IRA because it comes from a 401k that has not been taxed, and you would roll it directly into an IRA, which also will not be taxed until you take monies out. But it does give you more investment options within the account, and it gives you better choices. Other than, so for instance, your Fidelity 401k now, you can invest in, say, 15 mutual funds, right? Mm-hmm. Or a target date fund or something that's specific, but it's a limited amount of choices that can go into your 401k. If you roll it into an IRA, you can now buy any investment option within an IRA. You can buy individual stocks, you can buy bonds, you can buy mutual funds, you can buy exchange traded funds, you can buy into real estate investment trusts. There's different choices other than what your 401k has limited you to invest in. That's the benefit of taking from a 401k to an IRA. Then when you participate in a new plan, you want to see what the options are that they give you to invest in, whether it's a traditional 401k or a Roth 401k or a combination of both.
Gotcha.
Does
Okay.
that help? Okay. Yeah. Any other questions going forward on financial planning, insurance?
Well,
have a
so
question.
Rebecca, oh,
Hi, Patty.
sorry, Patty.
Oh, I
I'm
win.
sorry.
Okay, so I have on my own, in my own brokerage account, a Roth IRA and a traditional IRA.
Okay.
I just was let go from a job, and in that account, I have a 401k, which has some, I don't know what it's called, traditional, and some
Right.
Roth 401k.
Okay.
Is it ideal for me to roll them both over into my existing ones or to create brand new ones? Because I'm not sure if I'm going to do any traditional to Roth. I forget what it's called.
Conversion? A conversion.
And I know there's like that ratio
Right.
thing.
Well, if you have a component in your 401k that has a traditional and which is not taxed, and a Roth, which is you weren't able to make that deduction of income, but it's still growing tax deferred within the Roth 401k. You can roll each portion of your IRA, or each portion of your 401k into an individual IRA and an individual Roth IRA. And that you can certainly do that. You're just taking whatever the traditional portion is that hasn't been taxed into your traditional IRA, and the other portion of your Roth 401k into the Roth IRA. When people divide them or they keep them segregated, it's more because they want to track it. They want to track that amount of money, where it might go and how it might perform. I typically don't see necessarily an advantage to that, only because then you're opening up additional accounts. Now, instead of having your 401k and your Roth 401k and a Roth IRA and an IRA, now you're going to have additional, right? So it's hard to keep track of, and it's somewhat difficult to complement the overall investment strategy. So my suggestion would be that you take your 401k, the traditional part, put it into your IRA, your traditional IRA, and your Roth 401k, that part of it can go into a Roth.
Okay.
So, and if you have existing, it would just be combined. It would either come over, you can't typically bring those things over in kind, meaning the investments that you have.
Yeah.
So it would come over in cash, and then you would just reinvest it accordingly.
Right, so it's going from Fidelity into Vanguard, so I'm guessing I would have to.
Right, you can do that. Yep.
Yeah, thanks.
Yep. So, okay.
So
Great.
Rebecca, one of the questions I had, the reason that I had asked you to do this training now was, more than 3 million women have left the workforce this year because of COVID, because women tend to be the primary caregivers and trying to juggle work and childcare with kids working, going to school remotely or hybrid. It's just been prohibitive for so many women. So have you come across women this year in this scenario? And do you have suggestions for women in particular who find themselves in that situation on steps that they should maybe be taking to put themselves in a better position going forward, because this is obviously unexpected for so many people this year.
Sure. And of course, that's an unsettling situation, when we change jobs, lose jobs, whatever that might be. Of course, it's unsettling to move forward. But I think that's why it's important, starting today, right? To make sure you know what you have the ability to do, know where your resources are, and then moving forward, when you do, find a new position or whatever that situation might be where you're accumulating wealth, that's where you need to put things in the right places and make sure that you're doing the right things for yourself with your investments, whether that's tax-free, tax deferred, or if you needed to take distributions, that type of thing, and that's why it's really important to just come across, look at your budget, look at your income, look at your expenses, make sure that you're accounting for all these things. And, there's a lot of different tools. And if any of you want to, just look on my website or whatever, there's calculators for every scenario. There's calculators for if you, are sending children to college, at what point in time do you need to save and how much do you need to save on a monthly basis? There's calculators for retirement. There's mortgage calculators. There's, rent versus owning, and we're all unfortunately have been compromised in this past year, whether it's by our income or, lack of income due to the situation. But, to be prepared and to be engaged in your own situation is really one of the most important things that we can do for ourselves, because if you're caught blindsided and you don't know what to do, that's where we all kind of get into a position where it's uncomfortable and you don't know what to do. So we kind of freeze, or we take money from the wrong places. And that's where you need some guidance, and guidance is helpful.
So I actually have another question for you along the same lines regarding COVID. So my brother-in-law passed away 2 weeks ago due to COVID. So now my sister-in-law, is left with 2 kids, and we've seen the scenario many times this year. We were pleasantly surprised to learn that in France, it's legally required for people to get a mortgage insurance policy where when one spouse passes away, the other one, the mortgage is paid off. And,
Right.
I was talking with someone and we thought, okay, this doesn't exist in the US, but I was Googling it and apparently it does. There is such a thing as, I guess it's called mortgage protection insurance. Is this something that people should be, because the other flip side of things is even in a non-COVID world, as you know, as a financial advisor, and I only know this because I write about this stuff, but the average man dies 7 years earlier than a woman. So at some point in our lives, most women, whether it's through divorce or whatever scenario, we're going to end up financially responsible for ourselves. So is this something women should be thinking about? Should we all be getting, I know we have to get insurance for our mortgages, for our homes,
Right.
part of your mortgage requirement, but I've never heard of this kind of mortgage insurance. And I'm just wondering why.
Well, first of all, I'm so sorry for the loss of
No,
your
that's
brother-in-law.
not why I brought it up. I just,
No, but I know we had talked about it, when he was really not doing well, but I'm sorry for the loss of your brother-in-law. And, it's a terrible tragedy that we're all experiencing. We've all known people that we've lost. It's good that France requires that. That's a wonderful thing because it does protect people. But as you may know, and anyone who's gotten a mortgage, as soon as you sign the contract for your mortgage, you're getting flooded with communications for mortgage insurance, right? Mortgage insurance is life insurance. It really doesn't make a difference how you phrase it. Mortgage insurance, the way that they project it to you in that scenario, when you do get a mortgage or a home equity line or something like that, people are flooded with, you have to protect your home and protect this loan and protect what you've just signed your life away for when it comes to a mortgage. It's straight out life insurance, and it can be done in many ways. It can be done, a term insurance. If you get a 20-year mortgage, you get a 20-year term. You have a $300,000 mortgage, you get $300,000 worth of life insurance. It can be done, again, cash value life insurance, where it would be more expensive, but that would continue on and be permanent, where you could be 100 years old and still be insured, versus term insurance. So mortgage insurance is a fancy name that someone gets a list of, current mortgage purchasers, and it's just called mortgage insurance. That's how they market it, but it's straight out life insurance. So it really doesn't matter. I'm kind of surprised that France might, or other countries might require you to have that. I think that it's a great idea. I think that anyone who enters into, getting a mortgage, if they're going to compromise the person that they reasonably might leave behind, it could impact their life. They might have to sell the home, or, there may not be enough equity in the home to really benefit them for the long term. So I think that that's really a great thing to do, whether it's a mortgage. Life insurance is for, various things to carry on the way that you are accustomed to live, to have your loved ones carry on with the way that they are accustomed to live. So it's could be to pay off a mortgage in debt. It could be to, for an education. It could be to make sure that your children are, have the wedding of their dreams. It's a personal decision, but it does serve a purpose. And if you have, a large mortgage that you need to protect, then that's mortgage insurance, if you will. Yeah. So yeah, life insurance, I mean, it's to keep up with your standard of living, any loss of income, long-term expenses, college, wedding, retirement. It keeps the goals intact is really what it is. So if the goal was to pay off mortgage, it's kind of a different name that it's appealing to that segment of the market, that you have a mortgage, you need to protect it. So it's a good thing because it helps people to understand that the people left behind could be impacted if that mortgage wasn't getting paid. So, other thing with insurance might be insurance needs, the needs of insurance, whether it's group benefits. A lot of times people think that they have, whether it's disability or life insurance that's included in a group benefit. If you were to leave the workplace, you may not be able to take that with you. It may not be portable. So that's an important thing to look at. Maybe while you are employed, what does your employer provide, and is that portable to you? If you were to leave the job or lose your job, can you do anything to take that insurance coverage with you? Disability, it replaces a portion of income due to injury or illness, and long-term care. 70% of us will need long-term care, will require some kind of care. The average care is about $80,000 per year in a nursing home, $25,000 per year in a home 3 times a week. Now, if any of you know of people who need home care, that can be important. And then workman's comp, a lot of times people don't think of workman's comp. They think, oh, well, I'll get, through the workplace. The workman's comp will cover me if something was to happen. That usually is only short term, and, it doesn't last for very long. Property and liability insurance, and then working with professionals when it comes to retirement and investment planning, tax professional, financial advisor. You want to determine, and structure an optimal retirement plan through your employer or through yourself. If people are self-employed, a lot more people are becoming self-employed, and determining, whether they're becoming consultants or, the self-employment market has really gone up, where people are just doing things on their own. But what happens when people become self-employed, they don't always fund their own retirement. They don't fund towards their own retirement because they don't have a payroll deduction necessarily. So it's important, if you're self-employed, maybe real estate agent or private attorneys, even if you work for a small doctor's office or attorney's office, you want to make sure that they have some sort of plan in place. And if they don't, then you want to make sure that you're doing that on your own. And you want to just make sure that you're efficient with your tax planning and your expenses and your bookkeeping with tax changes. You also want to take advantage of employer-sponsored plans when it comes to your benefits. What are the benefits that they offer? You want to understand that, and you want to make sure that you sign up for those on a timely basis, because if you miss some deadlines, typically, towards the end of the year, there's different health plans that you can sign up for and you also want to take advantage of those flexible spending plans. So all of those things are just really important points. And I'll just reiterate what we went over was the 10 points that I was discussing were financial planning, retirement, your investments and asset allocation. Number 4, your protection needs. Number 5, your career and career changers. Number 6, taxes and being efficient with your taxes. Number 7, children and dependents, could be your parents. Number 8, your legacy. What are you leaving behind and how, and what is the purpose? Number 9, your estate planning. And number 10, life events, and to make sure that you update during those life events. And then, it's a little bit different for business owners, continuity, business continuity, whether that's a succession plan, key man insurance, if you're in a small company, or if you're, working on your own, key man insurance, buy-sell agreements, in the event of death or disability, who could take over your business, business evaluation, you want to determine an appropriate value, insurance needs and group benefits. What does your employer, or what if you're self-employed, can you provide? Are you providing for yourself and your family? Succession planning, estate planning, workman's compensation, retirement, property and liability insurance, and retirement investment planning. All those things are important points. And I can certainly share this with any or all of you. I can, let's see here, if you want to, I guess I could put in the chat too my personal information. And, then if any of you have questions, or you have concerns about your own personal situation, I'd be happy to share this with you, any of this. I'm just going to copy and paste kind of my overview. I think I can put that in the chat, or we can get that out to you. Select all. Did I do that? No.
Rebecca, I'm sharing my screen, and I think you can all see that, right? So
Oh,
there's
my
your
website?
Uh-huh.
My website, thank you.
No problem.
I don't see anything in the, oh, you're sharing the screen, Rich.
She's sharing that's my website. So here's
Gotcha.
my login information, my email and my number. I'd be happy to, go over anything with any of you. What happened to mine? Oh, did you just, I guess, because you're the person.
Do you want me to allow you to share your screen?
I'll just put my information in the chat, I guess.
I mean, I can have you, let me make you a quick, I will stop sharing my screen and make you a quick co-host. And
I'm a good Zoom attendee. I'm not a good Zoom.
All right, no worries. Well, your information's up here. So, I mean, I think people can
Okay.
reach you this
Yeah.
way. And then,
And then if you want to just email me, I'll just send you my 10 points, and so that you can understand really what we've done, what we talked about.
thank you so much, Rebecca, for doing this. And as I said, we're going to be turning this into a podcast. And so if Rebecca, if you want to send those over, I can put them at the front of the podcast.
Okay.
And they'll be right there and I'll put your contact information. That way, if anybody wants to reach you, they can just reach out.
Perfect.
But I want to thank you so much for doing this for us tonight. And thank you, everybody, for attending.
I only see my website right there. Can we go back to seeing each other or no?
Yeah, there you go.
There we go. Okay. My view is just of Britt right now. Okay. So if anybody has any questions or concerns, I thank you for coming and taking the time tonight. Just reach out to me, and I'd be happy to answer any questions personally.